Good evening, everybody. Thank you, as always, for coming along. I'm Jeff Boccaccio. I'm one of the members of the STA Executive Board. And well, thank you for coming along. Before I introduce tonight's speaker, I just wanted to let everybody know about our new STA Technicals to Trading Systems course, because it's coming up quite soon. It's the start of April when we kick everything off there. And this is a new one for us, but it's based on that Technicals to Trading Systems conference that we ran for a couple of years there. We had so much interest. That we decided to wrap more of a formal course around that. And so it's a practical approach to integrating technical analysis into the development of trading systems, whether that be like a discretionary system or automated or a bit in between. And so I'm one of the lecturers on that. I've got a couple modules there along with Malcolm Pryor and Stephen Hode and Tom Hicks and Thiru Nagapan. And so check out the website, the STA website, technicalanalysts.com for that one. Oh, I think Katie may have put the link in the Zoom chat for me. Thank you, Katie, as always. And so, yeah, check that out. It's coming up soon, and it's going to be quite a fun one. It's all Zoom-based, and there's sessions once a week or every 2 weeks or so, but the full schedule's on the website there. So tonight, though, we have the pleasure of hearing from Zoe Bollinger. Zoe is Vice President and Portfolio Manager at Bollinger Capital Management. Bollinger Capital Management's been around since 1988, started by her father, who some of you may have heard of, John. Now, I was fortunate enough to host a fireside chat with John, and I looked it up before our session today, and that was back in 2021. I can't believe it, how time flies. That one I think is available on YouTube or through the STA sort of members portal there if you ever wanted to check that out. That was a great chat. I was in the height of COVID, I think, as well. But also my partner Sonal Darbar and I had the pleasure of speaking with Zoe separately after that with regards to like her ESG efforts and the portfolio creation wrapped around ESG, which maybe we can touch on a little bit later if Zoe doesn't cover it already. Now, Zoe she is obviously involved in the Bollinger Capital Management. It's an RIA business, so a registered investment advisor in the US. It's sort of like a fund management business as well. But she is also a certified financial planner. And we were just chatting a little bit before opening up the call here about that. So it's an extra service that she can provide to their clients there. She is also now on the board of IFTA, the International Federation of Technical Analysts, so of which the STA is one of the members, I guess, a founding member, I believe, as well. Zoe's an international speaker on all things technical analysis and investment management. And tonight she's going to talk to us about relative strength portfolios, which looks super interesting. So I'm going to go ahead and hand it over to Zoe. Just a little bit on the housekeeping. If you've got questions, please feel free to drop them in the Q&A box with Zoom at any point, and I will try to integrate them into a bit of a conversation with Zoe afterwards, and we'll pull them in that way. But drop them in while they're fresh in your mind, and we'll do our best to cover them all then. So, ladies and gentlemen, let me hand over to Zoe Bollinger. Welcome, Zoe.
Hi, thank you all for having me. It's really a pleasure to be with you. Give me just a moment to share my slides. We'll get that going. All right. Hopefully you can see that. And if you cannot, let me know.
Let's come in. Thanks, Zoe.
Perfect. So today we're just going to have a little bit of a chat about sort of a practical approach to running a relative strength portfolio. Let's see if we can change slides. So what is relative strength? It's, one of those buzzwords that pops around, but can mean a lot of things to different people. So basically, at its heart, relative strength is the idea of measuring the performance of one asset. That might be a stock, it might be a future, it might be any sort of tradable asset against a benchmark asset or group of assets. So you might be comparing the performance of an individual stock to the stocks in its group. You might be comparing the performance of a stock to the market as a whole, to a major index. But it's looking at whether an individual asset is outperforming or underperforming a universe of other assets. You quite often also hear it referred to as momentum, especially at the institutional level. It's often the momentum factor is the most common way of talking about this. But fundamentally, the goal at the end of the day is to pick investments that have outperformed relative to the market of their peers or are beginning to show outperformance, with the idea that that outperformance will hopefully persist for at least some time to follow, and you'll be able to capture some of that outperformance in your own portfolio. So the core idea at the end of the day is own strong assets. Hold on to them as long as they continue to outperform. To use the metaphor of a group of people running a race, like you see in the image, you want to own the portfolio that is consisting of that front group of runners who are leading the pack. You don't want to get the index performance necessarily of that giant pack in the back. That's well enough, but it's what everyone else is doing, and you'd probably like to do a little bit more. And this is really this idea of relative strength, of identifying assets that are exhibiting strength. It's really classic technical analysis. It's letting the price performance of an asset guide our portfolio construction. And fundamentally, the opposite of the traditional value investing approach, with this idea of finding assets that are fundamentally undervalued with the expectation that the market will correct and bring them back to the valuation that they should have. A bit of a joke, but when you say relative strength, a lot of people's brain goes directly to RSI, the Relative Strength Index developed by Wells Wilder. It's a great tool. It's an oscillator you can use to identify overbought and oversold conditions. Often an interesting tool in building a mean reversion strategy, but not actually what we are talking about today. So what we're talking about today is relative strength, and there's really two ways that you see this expressed most frequently. In a charting capacity, you'll see it expressed as a relative strength line drawn on a chart. And that line will be rising when the asset is outperforming whatever the benchmark you've selected is, and it'll be falling if you're underperforming that benchmark. Um, but what we're really going to focus on today is this idea of ranking based on relative strength. So you use a relative strength calculation, and we'll talk about a whole set of examples of what those calculations might look like. And you're running that calculation on a universe of stocks or of assets of your choosing in order to rank the securities by their strength, strongest with the highest ranking, weakest with the lowest ranking, and use that as a selection criteria for a portfolio. So what is constructing a relative strength portfolio? It's calculating that score, ranking your list of assets based on that score, and then traditionally you purchase the strongest set of assets and you hold them as long as they continue to exhibit that strength, and you replace them as they start to exhibit weakness. And we'll get into a little bit more detail on how you might establish that criteria of where weakness begins. At the institutional level, you'll often see these also constructed in a long-short construction where you're long the strongest assets and short the weakest at the same time. And so there's a lot of different ways that you can play with this, but this is really the most kind of pure and basic form. So one of the really interesting things about relative strength is how long it's been around. We're going to go through a set of historical examples looking at relative strength calculations over the years, different approaches by different authors. They've been in the public domain for a really long time, momentum, relative strength, and it hasn't gotten arbitraged away. So this really comes down to some of these core ideas of supply and demand, and that when things are doing well, people want to participate, individuals want to participate, institutions want to participate. So as strength grows, we sort of, from a basic psychological level, want to pile onto that. And so if you're able to identify where strength is and get in somewhat earlier in the cycle, there are some good outcomes that are available. So one of the original, actually, maybe I'll start by apologizing in advance. There are a ton of people who've done really interesting work on relative strength. This isn't meant to be an exhaustive list of them, just a few highlights that I think will be interesting for today's talk. So if I miss your favorite relative strength historical figure, I apologize in advance, but we'll start with George Chestnut. He's really one of the original portfolio managers who ran the American Investors Fund starting in 1958, and he ran it through the 60s and into the 70s using a relative strength methodology. He wrote up his methodology in his book Stock Market Analysis in 1967, and kind of put his ideas out there into the public sphere. And his relative strength approach was really a two-tiered one. He started by looking at the relative strength of a group, so an industry sector, an industry group, and then he looked within those strong groups for the strongest stocks in the strongest groups. And he did his selection based on that. And one of the reasons I wanted to highlight him is, decades and decades ago, he was running a fund using this methodology with a live track record that was predominantly a really strong track record and quite successful fund. Robert Levy is the first of those that we're really going to kind of get into the methodology. He wrote a paper for the Journal of Finance in 1967, Relative Strength as a Criteria for Investment Selection, and went on to expand that into a book in 1968. He examined a bunch of different methodologies, all using weekly data because we're looking at figures in the 60s here. So running these calculations over a long period of time was a pretty onerous process. So a lot of the earlier relative strength different work practitioners all used weekly data. And the methodology that he settles on is actually a pretty simple one. He ends up using a basic 6-month rate of change to rate the assets that he's looking at for portfolio construction. So he basically does the close of the asset divided by a moving average of its close over the last 26 weeks. And he uses that as his ranking criteria for the assets to consider what to purchase for his portfolio. Our next example is Norman Fosback. He was active in the 70s and wrote his book Stock Market Logic in 1976. And he had also a rate of change. You'll see that this is a pretty common underlying factor in how these calculations are done. He took a longer moving average, a 30-week moving average, a little bit longer than Levy's, but then he looked at a shorter rate of change of that average. So he divided the current value of that 30-week moving average by its value 13 weeks ago. So basically a 13-week rate of change on that longer average to rank his positions. The next one's a name you've probably come across, William O'Neill with Investors Business Daily. When he wrote his book, How to Make Money in Stocks in 1988, he presented his quite famous CAN-SLIM method, which was a mix of fundamentals and technicals. But on the technical side, he used an RS methodology to identify what he referred to as leaders and laggards. And he did this with a set of different weights of the rate of change, starting with a 40% weight for a 63-day rate of change. He was using daily data. And then 20% weights on 3 longer rates of change, 126 days, 189, and 252. The real thing that you want to think about when you're thinking about the IBD or the O'Neill methodology here is it's quite front-weighted compared to some of the other methodologies that we talk about. So he has that heavy weight on the 63-day moving average, but even the longer moving averages that he uses also include that front-weighted, that same 63 days. So you get kind of a stack of the most recent data with tailing off weights on the older data. So this is really looking quite heavily and rating quite heavily on the most recent data for any individual asset ranked. And finally, in our sort of pure TA approaches, we have Robert Pierce. He founded an investment company, Cooks and Pierce, in 1984. And for many years, until his retirement, successfully ran an entirely TA relative strength-based set of portfolios. And he published a little bit about his work in 1997 in a paper for the MTA Journal, A Practical Application of Alpha and Beta. So he took a little bit of a different approach, kind of deflating some of the price information by a volatility metric, looking at beta. He didn't use what we kind of traditionally think of as an alpha and beta calc. He did his own. His alpha was a 1 week rate of change of a 99-week moving average. So he takes a really long, really slow moving average, but looks at just kind of the most recent week there for his alpha. Is it moving up or is it moving down, and how much? And then he divides that by a 39-week moving average of his approach to beta. When you read his work, the real emphasis that he places in his beta calculation is that he wants it to be agnostic to trend direction. He doesn't care if the stock is moving up, if it's moving down. What he cares about is the magnitude of the move. How volatile is it? So he takes a 2-week period, the current week and the prior week, and looks at the low price and the high price. Doesn't care what order they're in, doesn't care if it's going up or going down, and just calculates the percentage change from the period low to the period high. And that's his beta. So his final RS ranking is that 1 week rate of change for the 99-week average divided by a 39-week moving average of that beta calculation. So deflating for volatility. I'll give you a last example. This is a little bit different from kind of what we've talked about before, which are really purely price-based methods for calculating relative strength, but I think this is a bit of an interesting concept. Charles Kirkpatrick developed a hybrid version of relative strength that's looking at both the strength of price itself, but also the strength of some fundamental data. So what his relative strength score, he uses actually Levy's method as one component, that 26-week rate of change for price. But he also looks at relative strength in two fundamental characteristics: a relative earnings growth calculation and a relative price to sales ratio. So we want stocks that are moving up, that have companies, those are stocks of companies where their earnings are growing, preferably at a better rate than their peers. And he does the inverse with the price to sales ratio, gets a little bit of that value investing concept in there, wanting it to be a relatively inexpensive stock. So his buy and sell rules that he published in his book was you would purchase a stock if the top 10%, if it was within the top 10% of the universe by that Levy methodology of price strength, if it was top 10% in terms of earnings growth, and if it was below the 30th percentile of its price to sales ratio. So if it was a little bit cheap for being an upward trending growing stock. And his sell criteria looked at when price strength declined, that could trigger a sell. When earnings growth declined, that could trigger a sell. But he didn't take the price to sales ratio into consideration for his selling criteria. Felt that as long as you had purchased it when it was a relatively good valuation, if it got expensive while you held it, so be it. So one of the kind of interesting or nice things with relative strength or momentum is often when we're working in technical analysis, there's some skepticism at the institutional and academic levels. But relative strength is one of the concepts that's been quite proven out in academia and is quite widely accepted. There's any number of studies and papers on this. One of the most cited, most commonly seen is the paper from Jagadish and Titman in 1993. And they just basically tested these methodologies and proved that momentum strategies do provide outperformance over time, which is somewhat problematic if you are working with an efficient market hypothesis, but it's one of the few exceptions to that hypothesis that's kind of accepted on an academic level, as well as the results that you see in your own portfolio. So that's a bit of a walk through the history, some of the relative strength work that's out there. So thinking about those rankings, what do we actually need to think about if we're going to put together a portfolio like this? What are the factors we need in order to construct a relative strength portfolio for ourselves? One of the really interesting factors here is that, and we'll test some of this out and show you, but almost all of these calculations actually work. Um, they vary in effectiveness. Not all things are created equal, but most structures that you look at and most calculations that you look at, if you are finding strong assets, buying them when they're strong, you tend to get outperformance kind of regardless of what the calculation is, which doesn't mean that the calculation doesn't matter. Different RS ranking systems and calculations work differently and better or worse depending on the market that you're looking at, depending on the time frame you're looking at. They also have quite variable risk and drawdown profiles. So you do want to look at the different calculations and pick the one that's suitable for your particular trading environment. But across the board, the calculations are broadly effective. This is maybe the most important slide in a funny way in this presentation. All relative strength is based on this idea of ranking assets within a group. Uh, so your universe is maybe the most important piece of it and something that's often, if not forgotten, then de-emphasized. If you're looking at a list of stocks or a list of any asset type and you're buying the strongest ones, if those assets are not the asset that is driving current market performance, if nothing in your list is outperforming, having the best thing in your list doesn't matter. So taking the time at the outset and considering what is your list of assets, is it broad enough that when different market conditions change and occur, that you've got something that's going to outperform in that environment? That's really crucial because no calculation will save you if you don't have the assets that you need in your list. The other, and perhaps maybe second most important thing, is this idea of concentration. How many positions are you going to have in your portfolio, and how are you going to size those positions? For this presentation, we held position sizing constant. So there's just too many parameters, too many permutations. But you can do some really interesting work with variable position sizing in this, using different factors to decide how big of a position you should take in any given asset. The number of portfolio positions is also really important. This is the idea of kind of concentration versus diversification. And I'm sure for many of you, if you're working in technical analysis, you understand this kind of at a core level. But especially in today's market, if you talk to people who came up kind of through a traditional educational environment, we've really hammered home this idea of the diversified portfolio. And that's true if you want to get market returns. But if you want to outperform the market, you can diversify away any edge by having too many positions. So it's finding that balance of concentrated enough that you preserve the edge that your calculations are offering, um, while not so concentrated that it's too volatile of a portfolio for you or for your clients. The next aspect is time. So there's time in sort of two dimensions. What data you're using for your relative strength calculations. We saw earlier on that a lot of the sort of original practitioners were using weekly data. Now, obviously, with the computational strength to use daily data or even shorter. And what works for this will really come down to the asset class that you're trading, the time frame that you're trading, and that's something, there's not an inherently right answer, but it makes a big difference in the outcome. So you want to think through what the right version for you is. And then the second piece to timing after the ranking is how often you will consider portfolio rotation. So fundamentally, you're ranking your assets by your relative strength score, and then periodically you're rerunning the rankings and seeing what's moved. So how frequently are you doing that reevaluation? Is it weekly? Is it monthly? Is it daily? And again, that'll make a big difference to the outcomes as well. And also your turnover rate. So if that's something that you care about for yourself, for clients, for tax reasons, how often are you willing to change the assets that you're holding? And the last piece, which is also really crucial, is this idea of your exit metric. When we say you hold something as long as it's strong and you sell it when it begins to exhibit weakness, what's your criteria for weakness? When people think about relative strength, often you think about what gets called upgrade, this idea that you always hold the top ranked assets. So if you have a list of 100 assets, um, you buy the top 10, and then when you reevaluate, if one of those assets has fallen to your 12th rank, you sell it and you buy whatever the asset is in the top 10 that you're not currently holding. The other approach is called cast out, or you sometimes see it referred to as replace. And that's the idea of allowing you start with that top ranked set, and then you allow it to fluctuate within a certain set of bounds. And things can move up and down a little bit as long as they don't violate a defined level, maybe halfway down your list. If it falls halfway down your list, then you sell it. Or in the Kirkpatrick example, if you fell to the 30th percentile, anything below that got sold. So those are kind of those two ideas of where does that line of weakness lie that causes you to sell something in the portfolio. So enough with the theory and the ideas. Let's look at a little bit of testing and kind of see how some of this comes out in reality. We're going to test with 4 of those historical approaches that we talked about: Levy, Fosback, the Investor's Business Daily or O'Neill method, and Robert Pierce. And I put the years next to them. These are the years that they published their work. So one of the really interesting things here, going back to that sort of fundamental supply-demand characteristic, these have been in the public sector for decades. They're available in books and papers online. They've been studied, they've been tested by people other than me, and they still work, you know, differently, and to different degrees in different environments with different factors, but they all still provide outperformance, even at this time, which is something pretty interesting. There's not that many ideas that avoid getting arbitraged away for such a long period of time. So going back to those factors and parameters that we talked about earlier, for this, I use the Russell 1000 as the universe. That's one of the US large cap indexes. It's bigger than the S&P 500. It gives us kind of enough diversity of stocks. And I looked at actually rerunning all of this testing for the UK market, and I apologize, but I didn't have a data source that offered good constituency data, so you could have a long time frame testing without survivorship bias for index components. So I stuck with the US testing. Our time frame, I just took a 20-year slice from 2005, the beginning of 2005 to the end of 2024. And this obviously, if you're testing a method for yourself, you don't want to test a giant chunk like this. You want to test little slices with different environments so that you don't, as you play with different parameters, you don't end up with an overfit model before you run it live, and then you find out that you've entirely curve fit your data. But for a demonstration purpose like this, for things that have been so readily available, this just takes you through a real variety of market environments, including the Great Financial Crisis, including COVID, some really long bull runs, an inflationary period in 2022. So you get to kind of see these working across a really good cross-section of market environments. And in the next 2 slides, we'll go through sort of 2 permutations. We're looking at 3 of those exit metrics. An upgrade where you hold just the top assets, and every time you reevaluate, you sell anything that's not in the top. A cast out at the 25th percentile and a cast out at the 50th percentile. So for the Russell 1000, it's a nice round number. That's cast out if you fall below the 250th rank or the 500th rank. And we ran those for 10 and 20 position portfolios. So this is the 20 position portfolio. I'm not sure if you can see my mouse, but I'll try to circle things. The left 2 are the upgrade. The middle 2 are cast out, and the far right are cast out at 500. And for each, we have the rate of return and the max drawdown across the 4 methodologies with the S&P 500 as a benchmark at the bottom. And so I'll call out a couple of things to you here. One, interestingly, is that across all of these methods, all 4 with all 3 different criteria for an exit, in the rate of return, they all outperform the S&P 500 over the last 20 years. Some with a greater gap of outperformance than others, but they all outperform. The other piece that I'm sure your eye has been drawn to are the drawdowns. These are pretty unacceptable drawdown levels. Unadulterated, very few of us could sit through or want to sit through a drawdown like that for ourselves. If you're running money for clients, they certainly are not interested in seeing a drawdown above 50%, even even though this is taking into account the great financial crisis, where the market did draw down 55%. But that's something that we will address later, because while there is always a balance between outperformance and the volatility that you're willing to accept, that's perhaps more than we can accept. So this was 20 positions, and our next slide has the same breakdown, but for a 10 position portfolio. So looking at these, you get a little bit more outperformance in most of the systems with the 10 position. But you also, as you concentrate, you increase your edge, but you also increase your drawdown. So that's something we'll address later. To keep things simple and kind of limit the crazy number of permutations that I'm putting up on these slides for you, I did a real sort of quick and easy look to pick one of these combinations of portfolio concentration, number of positions, and exit metric to use carrying forward. And the piece that performed the best across the 4 methodologies was a 10 position portfolio with cast out at 250, or at that 25th percentile. The rate of return for 3 out of the 4 was over 15%. So we're going to use that for the examples going forward. So more parameters. Now that we've narrowed it down, what else can we test? The first is that idea of rotation frequency. How often are you reevaluating your list and considering making trades in the portfolio? Weekly and monthly are the most common. I'm sure there are folks that are using RS ideas at a much shorter level, but I generally have a medium to longer term time horizon. So I'm not looking to be doing daily trades. You certainly could, but as far as this goes, we've been using monthly so far for all of these tests that I've shown you, and here's why. For these 4 methods, looking with 10 positions, for all of them, well, for 3 out of the 4, monthly rotation significantly outperforms. And for the one where that's not the case, which is Fosback, it's a very equivalent level of performance. You have a pretty minuscule difference in the rate of return, so it's held steady. So if you get better performance, but with a longer holding period, and looking at monthly rotation, why subject yourself to greater turnover, at least as far as these methods go? And that kind of brings us to this question of those drawdowns. There may be some relative strength purists who are willing to kind of go through that whole cycle, but most people, that's not going to be the case. So what are our options for hedging or doing some filtering based on the overall market trends? There are a couple of different ways to look at this. We're going to use a really basic example here of the S&P 500, just looking at a 6-month moving average crossover. There are obviously much more sophisticated ways to do this. You can run long short portfolios, you can have different metrics and hedge when you meet certain conditions. But I wanted to pick something very, very basic on purpose, just to demonstrate kind of the impact and the characteristics of doing a little bit of trend filtering and hedging. There's 2 really basic ideas to doing some of this market filtering in relative strength. The first idea is to not replace positions that are sold if you are in a negative market environment, however you define that. So in this case, if the S&P is below its 126-day moving average, it's the end of the month, you re-rank your portfolio, there's something that meets your sell criteria, you sell it, but you leave that amount in cash until the next time you rank it where the S&P 500 is above its 126-day moving average. So you'll slowly, during negative times, as you sell positions, build up cash, and then when that negative condition ends, you'll go back into a portfolio. The other idea is to simply go to cash if you reach your hedging criteria, your negative market condition. In the testing that I'm going to show you in a moment, the way we did this was if you reach that month-end evaluation point and the S&P 500 was below its moving average, then you sell out the entire portfolio and you wait until the next month end where the S&P is above its moving average, and at that point you buy a fresh portfolio made up of the highest ranked items at that time. So I think this is easier seen in some ways in an equity line than looking just at a table. So this is the equity lines of those 4 samples that we talked about. You have Levy in green, Fosback in red, Pierce in that kind of orange, yellow, gold, and Investors Business Daily O'Neill in the blue. And so this is that 20-year period. You see that Fosback in particular gets pretty annihilated during the Great Financial Crisis in 2008, 2009. It's the slowest in terms of its calculation. And so it will give things quite a lot of time and continue to hold them as market conditions change. But all of them got pretty beaten down during that time. We also see all of them take a beating during COVID in 2020. And a number of them have a bad time in both 21 and in 2022. So we see a couple of periods with some pretty meaningful drawdowns. So what if we apply that filter not to replace if the conditions are negative? The first thing we see here is that at the bottom of 2008, 2009, 3 of the 4 systems are entirely in cash. They've gone flat. So as they've gone through and sold and sold and sold, they've ended up with their entire portfolio in cash. There aren't really other periods. There's a little piece where Levy goes entirely to cash at the end of 2022. But this is kind of the only area where they're fully in cash. But we do bring these equity lines into a smoother formation. You bring FOS back up so it's not massively below its peers, and you kind of get a smoother ascent overall. It's still somewhat choppy, but that's the nature of the beast. I think this helps see a little bit what's happening. This is the exposure of the 4 systems. It's a little bit easier to look at in the testing software. It's a little harder as an image because the 4 are stacked on top of each other, with IBD in front, followed by Pierce. So you don't see Fosback and Levy as much. But you get a sense here that there are periods where, depending on the system, it starts to sell and it reduces its overall exposure. To various degrees, sometimes down a position or 2, or sometimes down all the way to cash in 2009. So what if we look at that idea of going to cash entirely? Once that moving average crossover has occurred, you hit the end of the month, you sell everything, and you don't rebuy till the next month where you're above the moving average. And this one kind of knocks out the drawdowns in 2008, 2009. It does have, and it goes to cash a number of other times throughout as well. And it brings these a lot closer together through the earlier periods of their performance, though we start to see a real divergence between the Fosback and Investors Business Daily performance in recent years versus Pierce and Levy, which lag in the sort of post-2022 environment. And this is that same exposure chart. So you see these like clear window gaps where you've gone to cash a number of times throughout the year. And so there's pros and cons to this. On one hand, it helps you risk off. On the other hand, depending on the capital gains tax structure, wherever you're trading, you may be taking meaningful gains at various points where you go to cash. And this is just a table that lets you see how the different results stack up in an aggregate rate of return across these different methods of trend filtering or hedging. Um, so starting with no filter, you see that you have those quite strong overall rate of returns, but with drawdowns that are worse than the S&P in every case. When you look at the don't replace column, you see some reduction in performance for 3 out of 4 of the methods. Levy, Fosback, and IBD all come down a little bit in performance. Pierce actually goes up a smidge. But you see all of those drawdown numbers come in to less than the S&P drawdown. Still not great. 40 something percent drawdowns, not super comfortable, but a meaningful improvement from where we were prior to that. And then I think the go to cash is maybe the most interesting because it really highlights why, even though all of these methods work, it matters what method you're using with what combination of hedging. Because for Fosback and Investors Business Daily, going to cash during these down periods creates massive outperformance compared to nothing, compared to not replacing. In both cases, you get much better rate of return numbers with much better drawdown numbers. But with Levy and Pierce, you get those better drawdown numbers, but you get some underperformance, pretty meaningful underperformance compared to their less filtered results, even though they're all still above the S&P. So it's something that you want to play with, especially if you're looking at running this for yourself. What kind of hedge do you want to use? And how does that particular hedge impact the specific calculation that you're looking at in different environments? So we don't want to paint an overly rosy picture. Everything, even if it's great, has its issues. There's a few things you really want to consider looking at relative strength. One is this is something that often shows meaningful underperformance following big bear market lows. That's because fundamentally, these all are a little bit backward looking. They're looking at rate of change and things that have been strong up until the moment that you're evaluating them. So at the very bottom of a bear market, what's been outperforming is really defensive stuff. And you'll often see yourself, if you're in at all, you're in a basket of utilities and similarly defensive types of assets. Where when that bear market does finally ease up and starts to reverse, what usually provides the performance is the things that were the most beaten down and the most destroyed during that bear market. So you'll see tech, for example, rebounding and providing the real outperformance after a bear. And if you're in a relative strength portfolio that's holding all utilities, you're not necessarily participating in that. Also, depending on your calculation, you can be quite sensitive to short-term volatility events. So something like the Investors Business Daily, which is quite front-weighted. If you have bad earnings or a updated guidance announcement that causes a big one-day hit, that could shake you out of a position in a stock that's otherwise continuing to trend. So it's just something to be aware of. Portfolio turnover. These are, especially depending on your time frame and reevaluation period, these portfolios do rotate. So if you're looking at an institutional environment where low turnover is a priority in how a manager is evaluated, something you want to think about. And also, you will take gains eventually on something that's gone up a couple 100% in your portfolio. So if, depending on the capital gains regime, that's also something that you want to think about and plan for. In the US, we often run these in retirement accounts, in IRAs or 401ks, different types of pension plans, because then the capital gains aren't taxed. Changes for different jurisdictions, but something that you might want to think about. And the other piece we've already touched on with these drawdowns, these are volatile. They have volatility on the upside, which you enjoy, and they have volatility on the downside, which can be less enjoyable as well. So this has really been kind of a broad overview, a bit of a historical look, some practical ideas. There's a lot more complexity that you can take into account if you're looking at actually running one of these. One idea is a more dynamic approach to position sizing. So based on different criteria, You might enter a position at a larger or smaller weight compared to the peers in the portfolio. You might trim after certain conditions. If something has gone up too far, you might take profits. So there are different ways that you can look at position sizing that can really impact your performance. Obviously, what we used for the market trend filter of that S&P 500 crossover is an extremely basic approach to looking at market trend or when to hedge. So you can take much more sophisticated approaches to when to put on a hedge. You can take much more sophisticated approaches to a long short construction here. All of those help to mitigate that drawdown and, could be a presentation in and of themselves. And the other thing that I've been thinking about a lot and have had some really interesting conversations about, we talked about that sort of after a bear market, RS underperforms. Are there market environments where you want to be running a relative strength portfolio versus perhaps switching to a different tactical type of portfolio under different market conditions? Do you want to run this full time year in, year out, or do you want to have a few different things that you could swap between, depending on the market conditions overall? So there's a lot of interesting things that we can play with. But I think I'll stop here for the time being and take any questions that Jeff has for me from everyone. And hopefully it's been a nice little intro, giving you some food for thought in terms of relative strength.
Zoe, that was great. Thank you so much for running through that. Super, super interesting. Where to start with this? Well, let me start with one that came through from the audience. This is Adam. I know Adam, and I kind of had this on my mind as well. You talk a lot about the different sort of parameters there, and one of them can be when in a month, when during the month do you actually
Yep.
do your evaluations, right? Are there, I know that there are certain strategies that try to get those sort of end of month flows when like everybody's making new contributions to their pension funds and that sort of thing. So have you, or are you familiar with any of these?
So we did some testing around this actually, and I found it a bit counterintuitive. I thought that there might be some advantages to trading mid-month or kind of off of those month-end flows, that maybe you'd be able to capture where the fund flows had gone in if you evaluated it in the second week of the month, something like that. But you get real outperformance doing it at the end of the month with everybody else. That is that is where the performance lies. We played with that with a bunch of different scoring and a bunch of different structures, and end of the month is the name of the game.
Okay, cool. How about, and this is getting a little bit specific now, but when you get to the end of the month, because I'm familiar with some of these strategies, I run some similar stuff myself. And, not only like the time of the month, and like, so even at the end of the month, one of them could be, oh, okay, cool. You go and do all the back tests, you get the data out, you know how that test is run, but sometimes like the difference between being able to execute, right, based on like whatever the assumed price that you're going to get is during a back
Yep.
test might be quite different, right? So it could be, okay, end of the month, like as in like the closing price of the end of the month for each of the assets. So do you do it on the last day of the month, trying to get near the close? Or you're just using end of month data, I guess, but sometimes you'll get a gap, the next day, and sometimes at the end of the month specifically, you'll get a gap because all these flows are happening. So how do you think about that or handle that?
Yeah, so slippage, that sort of difference between the fill that you think you might get and the fill that you actually get, is real. The way we do the testing is it evaluates end of month data and it expects to trade at the open of the first trading day of the next month.
Gotcha.
Um, in reality, we do something kind of like that. We get the end of the month data for the portfolios that we actually run. We run the rankings after the close of the end of month, but we don't actually try to trade the open. We usually end up trading a couple hours into trading. You can have all of those orders sitting at the open, but as you say, if there's gaps, if things move around, then your weights end up being off. You can get some kind of quirky stuff. And we've run testing. This testing didn't have it, but a lot of testing software has some accounting for slippage in there that you can, some settings you can do to say, don't give me best execution in your test assumptions. We try to use that, and we've found that over time, when we go back and run a test on something that we've actually done, we get pretty close. It doesn't make like orders of magnitude difference in the rate of return. Also, because sometimes the fill that you actually get is better
Yeah.
than it thought, and sometimes it's worse. So some of that kind of comes out in the wash.
Yeah, I totally understand that. Yeah, it's going to be some messiness in there, and you're just going to have to deal with it. That's what makes the market, right?
Yeah.
Another question from the audience, Jason this time. You looked at the end of a bear market into a bull market, but what
Mhm.
happens for the top of a bull market into a bear market?
So, generally speaking, and that's why you do want some of these trend filters or hedging or like something in there to cushion things. Often that's quite problematic in terms of a RS strategy. When you get what has been really strong leadership and you start to roll over, often that leadership gets punished quite severely
Yeah.
early on in a bear cycle. So that is definitely a, whether you call it a weakness of relative strength, something to watch, something to try to have a hedge strategy that's a little bit forward looking without being so forward looking that you're giving up, months and months of good performance towards the end of a cycle. But that is an area to watch. It's problematic.
I mean, it's the same sort of thing with any kind of trend following strategy, really, right? So you want to give it enough, enough space, enough leniency so that you can follow that trend up. But then, at some point, you're going to look at it and be like, oh, if we would have just got out there, we would have maintained so much more of the goodness, right? So
Yes, the curse.
it's a balance. Um, do you find that like you talked a little bit about let me just make sure I'm going to use the term that you used. Yeah, basically concentration, right? Or
Mhm.
concentration risk. Because, you know, especially like, well, let's think about like what's happening recently, right? You've got like the Mag 7. They've been kind of pushing everything, just those seven. And if those seven are in your universe, right? Whatever that universe might be, they're probably the top things in your universe, right? And then so they're all doing really well for a long time and everything's looking great, but then they all kind of unwind at the same time as well. We've seen a lot of that happening recently.
Yeah.
Um, is there anything that you do to try to maintain some of that diversification? I mean, I know you talked about it, right? If you diversify, you're going to get market returns. If you allow the concentration, then you're probably going to outperform, but then you're going to have probably higher volatility and it's going to unwind sort of at the same time. So, any tips or anything that you've considered in that regard?
Yeah, so I'll kind of answer that in two pieces because there's the concentration in the sense of position sizing, and then there's the concentration in terms of like industry group sector type of concentration. So we find that more or less up to your risk tolerance, more concentration in terms of position sizing, less positions gives you more outperformance. Almost exclusively. There are the occasional exception, but broadly, the more concentrated you're willing to go on something like this, the more performance that you get. I'm not saying, one position, but 10 does better than 20, 5 often does better than 10. Um, can you run a 5 position portfolio for a client? Probably not. Can you run one for yourself? Maybe in a smaller account, as with, as your risk allocation, that's something you can think about. So there's to that degree, but you get with that outperformance. If you're holding a position portfolio and something in that portfolio drops 20% in one day, you are experiencing fully that drop in your portfolio. So it's a balance there between how much exposure you want to take, and that really is a personal risk tolerance question. Um, Diversification on the sector side or the group or in industry group side, I believe in very strongly. So in everything that we run, we have, depending on the number of positions, we have some requirement that no more than N can be in any one industry group. So if you've got a 10 position portfolio or a 20 position portfolio, 5 positions should not be tech stocks.
Correct.
So we'll often have, when we run those evaluations, we'll have a skip. So you'll look at the next highest thing that you're not holding and you'll say, oh, but we already have 3 in that sector group. So we're going down 1 more and we're going to buy something that's going to add. We've got a lot of tech. We can't buy number 4, but number 5 is, a medical device company, or number 6 is an industrial company. So
Right.
that type of diversification, the more the better, to some degree.
Makes total sense. Zoe, would you mind unsharing your screen for a second, just so that I think people have your contact detail there, Zoe@bollingercapital.com. And then that way we can just have a chat and it doesn't look like these little postage stamps. So yeah, with regards to diversification, you make me think a little bit. I mentioned before we came on today that we spoke with Perry Kaufman last month, and he was talking a lot about diversification and about how by not diversifying, you're actually probably going to get better returns, and how sort of like the sweet spot for diversification is actually quite low to try to get outsized returns. But you, of course, the wider you go on diversification, you're going to end up with that sort of market risk, or even worse, right? Because you're not sort of like chasing the thing that's actually making the money. So yeah, it's one of those choices, right? It's one of those choices that you need to make. With regards to the sector side, have you ever heard of or experimented with running sort of separate universes by sector? So rather than sort of doing a universe of, say, the Russell 1000, but then doing some checks of like, well, let's see how many we're going to allow in tech. What if you just had like a tech sector and then do all your RS on that, and then you've got biotechs? And have you ever heard of that or experimented with that?
It's something I'm actually playing with now. Funnily enough, putting together this presentation made me go back and read George Chestnut's book. And he does a chunk of that, where first he evaluates for sector. And so he'll hold within a couple of sector silos the best performing stocks within sectors that are outperforming. So it's something that I'm playing with, but I don't necessarily have results yet in terms of, is that providing outperformance? Does it? How many sector silos would you want? How diversified do you want to be across your sectors? That kind of thing.
Yeah.
But I think it's a really good question. I'm personally interested.
Cool. Me too. um, Another question from the audience. You've kind of answered something similar to this already, but when you're entering a bear market, and people might be thinking about this right now, if you are expecting a downturn, are there any like tips for like what to do best performance? I mean, I know you talked about a couple of those sort of hedging strategies, like if the S&P drops below some sort of moving average, then you've got choices, right? Are there other things that that you or that you know of people doing, like combining maybe like an RS system with a complementary strategy or something?
Yeah, so there's a couple of different answers to that. The simplest answer, if you're looking at like just a pure long side RS strategy, is have tested before you ever go live with it a set of hedge rules, whatever they may be. Maybe if X condition is triggered, you put on some percentage position of an inverse ETF to provide some counterbalance. Maybe it's a go to cash kind of thing, but whatever it is, have those rules tested. And then when the situation starts to arise, follow your rules. Because where we mostly see and hear things blow up is where people have a rule set, and whether it's an intuition that things are going to go wrong and they get out too soon, or an intuition that things are going to come back and they ignore their rule, and then they're like, why didn't I sell 6 weeks ago when I was supposed to? So at the most basic level, have your rules, have them tested, and then stick with them.
Yeah.
In terms of additive kind of things, you can run long short RS. It's an interesting thing. It works quite well. So you can have, 75% of your thing be long, the top items, and 25% be short, the worst. And that provides some interesting ballast. It also will drag on you a little bit sometimes on the long side if the bottom stuff kind of keeps turning up because you're in a really strong bull market. But usually that can be really helpful. I've also seen people do a few sleeves where they'll have in their overall, whether they're doing it in different accounts or within one account, an RS component, and then they'll run a mean reverting strategy at the same time. Or a different structured trend following, like breakout breakdown that allows shorts. So generally actually, if you want to talk about diversification, I think that's one of the nicer ways to do it, is to be running a few different types of strategies that outperform in different types of markets rather than trying to solve all things within a single portfolio.
Yeah. So system diversification.
Yeah.
Great. Again, we've touched on this a little bit, but a question in from the audience from Barry. Very enlightening presentation, he says. The calculations are based on the stocks relative to its own price or to its group. And so again, as opposed to like maybe is it an index or a group or a sector?
So all of these calculations actually do the stock to itself, the ones in this presentation. When you see an RS line on a chart, for example, those are almost all calculations of the performance of that stock relative to an index. So it'll be like the daily rate of change of this, like a calculation based on the daily rate of change of the stock versus a calculation of the daily rate of change of the index. So you'll see that line turn up when it's outperforming the index, or sometimes they'll use a group ETF also if you want to do that kind of more sector focused. So these are all stock relative to that stock's own history. So you're trying to see the stocks that are giving you that upward momentum versus just outperforming the index.
Gotcha. That's great. What about the algorithmic trading? Another question from Yahaya. How, like, have you seen this affecting the strategies? Is it positive or negative? Does it not matter at all?
Okay, I am not 100% sure this is algorithmic trading, but we generally think it is. Just the level of volatility in the markets on both the up and down side is unlike sort of I really started working on RS portfolios in 2018. And at the time, that's not ages ago, it's not the 60s. And at the time, a big move on a stock would be like a 6 or 7% day to the upside or the downside. And now I feel like in high RS stocks, you consistently see 15-20% moves in a stock in a day. And I think that is related to a lot of these algorithmic risk on risk off model based, where they like really pile in, they really pile out with very, very short time frames. So it may come out net neutral, but you feel it a lot on a day-to-day basis. You see these portfolios move both to the upside and to the downside.
Yeah. Totally understand that and see that myself. If you, it brings something to mind just for me, just as we're just sort of brainstorming here, and because it's recently we talked to Uncle Perry, to Perry Kaufman, and he's got a volatility, basically like a volatility exit. So if something breaches a certain level of volatility, it doesn't matter whether it's upside, downside, anything, but just the volatility gets so high, you're probably better off being out of it, in his view. This is for some of his longer term trend following models, I know. So yeah, you could almost just say, okay, if something starts breaching a certain level, you know what, it's just going to fall out of the calc of the basket, and then we'll wait for it to calm down, and then maybe something else takes its place. So that's great. So yeah, is thanking you for the response there, by the way, on the algorithmic side.
We haven't played with taking it out of the basket if it's too volatile, but we definitely use and look at, You saw it a little bit in the Pierce calculation where he deflates by his beta.
Yeah.
Versions where you deflate the score by
Right.
volatility, I think can be very helpful. So if it gets too volatile to either the upside or the downside, the divisor gets quite large. And so it's, upside gets deflated and moved down the ranks, maybe compared to something that's just like ticking up nicely for you.
Yeah. Yeah. Gotcha. I noticed on that particular, which one was that again? Which of the four models?
Pierce's,
Pierce.
Robert Pierce.
There was the let me just see what it was called there. Fosback, I think that one.
Yeah.
Which was, what was super interesting to me, watching the Fosback when your eye gets drawn to the drawdowns, and it had the highest drawdowns for most of it, I think, until you had like the total risk off S&P version. And
Correct.
then drawdowns were better, right? I mean, still, all of them are fairly high, so you need to balance that. But it was in line with the others, shall we say. And then actually, at that point, the performance had like regained, I think it was top or right up there with like the top two of those. So that was interesting to see. So another question from Devang, just asking if, over your years of experience and checking out these different methods, which do you generally fall back on of the four?
I don't use actually in the portfolios that I run, I don't use any of the four of these exactly as they are. We have built our own sort of modifications of a few of them, looking at the characteristics that we like and don't like. And so I guess the highlight is something like Fosback or Fosback related um, has lower turnover than some of the others. It's a little bit slower moving. It tends to identify those longer term trends. But because of that slower movingness, you also, if you don't hedge it in some way, it will keep holding through a quite big drawdown. So if you're looking for something slower, a hedged version of Fosback can be quite nice. If you're looking for something a little bit faster, a little bit more responsive, a version of IBD can be nice. For me, that's a little too front weighted. We run some versions of that are a little bit deflated or a little bit less front weighted. Kind of smooth things out a little bit, get less of those responses to individual volatility events. So I would say I view all of these historical ones that have been in the public sphere for so long as jumping off points. They're valid ideas. They're strong ideas that have stood the test of time, but you probably want to adjust them a little bit based on your needs, modern markets, the level of volatility that we're looking at, that kind of thing.
Gotcha. And so do you guys run your own flavor of this at Bollinger Capital?
We do. We run, actually, funnily, the ESG portfolio that I talked to you about years ago.
Yeah.
The idea behind that was to select a universe that had some positive environmental characteristics and then run a relative strength portfolio on that. So you actually got some performance while you were doing that. So we've been running that for quite some time. And then both John and I run some RS portfolios for ourselves individually that I think we are going to offer out to clients probably towards the end of this year. But a lot of that has been a discussion around sort of those drawdowns and what you're willing to accept for yourself versus what kind of hedged or adjusted version you need to be in to offer it out, so that somebody else is comfortable with the drawdown. Because most people, completely understandably, even if you're looking at this for, these should be sort of the growth / risk component of your portfolio, and they should be balanced out by other methods, by some much more stable, slow growing items. But it's finding that balance of what continues to give you that outperformance, but with a palatable amount of volatility for your average investor.
Yeah. Yeah, no, it totally makes sense. And my mind jumped to the extreme, which would be like, it's like which is the selection criteria at the top, and the extreme would be just the top one. Like, what is the relative strength leader at this point in time? and which would probably be how you would catch something like an NVIDIA or a Coco or one of those things which would hold up for a while. And then yeah, you're gonna have to just suck up the volatility that is inherently gonna go with that, especially as it really starts gathering attention.
Well, and the interesting thing with RS portfolios in general is you'll see that as you run them over time, the majority of your performance ends up coming from a relatively small number of the items in your portfolio. Because fundamentally, by the time things become strong enough to grab the attention, the high rank in an RS portfolio, some of them are nearing exhaustion. And that's just the way it is. And it's why we kind of don't run single. Um, you want a little bit of diversification because you'll buy a set of those and a subset, I'm making up numbers here, but if you buy 10, 2 will really like scream for you and really provide performance. Another 4 of them will go up, but not maybe with the same momentum that they had. They'll go into sort of a more gentle trending environment. And the remaining 4 might roll over and you'll rotate out of them relatively quickly,
Yeah.
depending on your time frame. So you want enough space there to capture and then hold in the long term that handful that really delivers.
Yeah. Yeah, no, it makes total sense. And what's nice about some of the RS portfolios, right, is that you have that rotation back out because it means, compared to something like a breakout, breakdown, I think you called it, like the CTA style, trend following, rather than something having to wait until it breaks below, sort of like a period's low. It may just be that, oh, the momentum's come out of this relative strength. It's not the leader anymore. It's fallen out of the top 5 or 10 or whatever it might be. And you're actually exiting at a fairly nice point, just as it's sort of just pausing, but maybe before a decline, or maybe it's just consolidating. Meaning that you don't have to necessarily give back a lot at the end of a big uptrend. But of course, sometimes you will. Sometimes you'll be holding on there. Very good.
It was one of the things that was actually a little bit of an adjustment for me from a portfolio management perspective, starting to run RS portfolios is sometimes, especially during a pretty smooth bull market environment, something will just pause for a while. It'll just like consolidate and go sideways for a little bit. And if the market's really strong, that might hit your exit criteria. And you
Yeah.
look at it and you're like, if this was in a regular portfolio, if this was just in a buy and hold portfolio, not in your life would I sell this. I'd let this consolidate and I think it'll go back to growing. Um, but following the rule set I found is really important. When I first started this, I was quite tempted to make adjustments and be like, I know better. Like, this looks fine. We're just going to hold it for a little bit. And then you hold something that goes sideways for a while the thing you didn't buy is just making an actual killing.
Yeah.
So it's an interesting quirk of these.
Yeah. Yeah. No, I mean, I think that goes for most systems. It's one of the things that, we're putting the systems course together and you start looking at all of these aspects. And it's always great. Once you start running these things, live and for real, the temptation to interfere is always
Strong.
there, right?
Yeah.
Have you tested or looked at any of these relative strength portfolios with monthly data, as in just the end of month data, rather than I think you mainly talked about daily and weekly.
We did. And it was really interesting, actually. We did some historical testing using monthly data, and back in time a little bit, it provided real outperformance, actually. Um, we did both monthly data and just like very long-term RS, looking at calculations that like ranked it on 10 years of performance, that kind of thing.
Right.
Um, and a while back, it was actually the way to go. And as you get into the last even 10 years and more so as we get towards today, maybe it's the algorithmic trading, maybe it's just everybody having Robinhood on their phone. Even you wouldn't think institutions are moving that fast, but we just see the markets are moving faster. And so
Mhm.
those really long look backs, those monthly data bars, they start to outperform as you get closer to today.
Yeah.
Underperform, I apologize.
Yeah. Yeah. No, I see what you're saying. Yeah, it's a balance. So for some of the longer term stuff that I run, it doesn't necessarily need to be a longer period of time on the like actual time look back. So, we're talking about like maybe 126 day, which is like, um,
Uh,
is that, uh,
6 months-ish.
yeah, yeah, 6 months is. Um, so you could use like 6 months of but just using monthly bars for it, right?
Oh, I haven't
Or
played with that. No, I
yeah,
haven't. That's interesting.
because you can kind of end up doing the same rate of change calculation, but you're only using that end of month data. So I mean, in theory, it's kind of like you're looking at the same thing, but it's a slightly different take on it. And then you can wait, you can still wait shorter term a little bit, or combine and blend these shorter terms with longer terms. And that's what some of the systems that I look at are doing.
It's
And yeah,
really interesting, actually.
it's
I would
always
love to.
interesting. Sorry, yeah, and it's interesting to look at for me too, because it's oftentimes, when you do a rotation or something like that, as you're rotating into the next thing, you might look at that on a chart, being chartists like we are, and you're like, oh my God, it's so overbought. Like it's just going like this. Now, how can I buy this thing way up here, right? But then you look back in a few months' time and it just carries on, right? Because it's that momentum that you mentioned at the beginning, right? You're looking for that momentum to continue.
It's one of the hardest things because we always do look at the charts, partially just to double check um and identify like buyouts. There are certain things where you'll like look at the chart and you'll be like, ah, this has momentum because somebody made an offer and it gapped up 50%.
Right,
Um, this is not eligible. So
right.
we always do look at the charts and coming back to that instinct to interfere. You look at this, you're like so overbought. But then when you don't buy them, you regret it.
Yeah, that's it. Um, just a couple more. I know that we're over just a little bit. We've talked mainly about stocks today, right? So Russell 1000 stocks, for example. Have you looked at, or do you look at ETFs for capturing broad sectors, and ranking amongst those?
Yeah, we have and we do. It's not something we offer to clients, but personally we run a version. And it works well. It's just a question of a large enough list.
Yeah,
So pick an ETF provider with a big enough list of industry group ETFs. And you can run quite a nice RS strategy on that, holding based on group strength. You can look at it also in terms of different asset classes or, style, growth, value, large, small, that kind of thing. So you can rotate amongst asset classes. It works pretty well. It's just, when you're looking at stocks or futures contracts, or there's many. Um, so it's just making sure that you have a list that's long enough that it allows a little bit of fluctuation of the assets before they get cast out.
yeah, perfect. Again, that makes total sense to me. Um, well, I think we've kept you long enough. Thank you for taking the time to speak to us today, and for going overtime with us a little bit here. It's been super interesting. I just get totally sucked in, and now I want to go and test some stuff out myself. Um, and so thank you again. And so for everybody watching, is the best place to connect with you? Is it bollingercapital.com?
Yep. You can shoot me an email. I'm on LinkedIn, but I will admit that I check that probably once a week. So if I'm not ignoring you, I will get there. But email is probably the easiest way to reach me.
Fantastic. Well, again, thanks so much for coming along, and super interested with you, taking the interest in both talking to us today, being involved with IFTA, talking about relative strength, and what you covered with the sort of like the academic papers on that is actually quite useful for TA as a whole, right? It's always good to see like some academic papers, because like you said, there aren't that many. So I may have to check some of those out too. Well, Zoe, thank you again for coming along. For everybody else on the call, just as a heads up, for next month at the STA, it's going to be an in-person meeting. We're going to be at the usual spot at One Moorgate Place in London. And we've got Ron Williams and Robin Griffiths coming along to give us some updates there. Zoe sounds like she knows those guys. Um, and that should be a good time. It's always great to talk to both of them, and they've got some updates on their factors. And in fact, if my memory serves, some of Robin's models are relative strength based primarily, right? That I think they'll be updating on. So yeah, come along to that. That'll be a great time, and look forward to seeing you all then. And everybody else, have a great rest of your week. Be careful in the markets out there. It looks like it's still volatile a little bit today. And Zoe, thanks so much. And it looks like the sun's come back out there a little bit in LA.
Really.
Yeah, I meant to say earlier that she's coming to us from LA today. So that was great. Thank you, everybody, and we'll see you in the next time around.